Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Tuesday, the 9th of July 2024. So, before we jump straight into our crux of today's Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so now before we jump, we call it straight into our usual intraday short-term technical outlook on the major US dollar pair, the major stock indices, and the two key commodities, i.e. gold XAU/USD and West Texas crude oil. Let's have a recap what has taken shape yesterday in terms of economic data release, how the various cross asset perform, and as well as any data that is of significance that has been released earlier today ahead of our usual daily dose. So let's take a look at the data released for yesterday first. So I would say that yesterday is a rather quiet US session. If you could look at my screen over here. Okay, so there's only one data that I want you all to take note of yesterday that was being released is this US consumer inflation expectation. All right, so over here. Okay, so as you all know that inflation expectation, there are various bodies in US that does this study. It could be from the University of Michigan inflation expectation data. It also could be driven by, we call it market inferred inflation expectation as well, taken from the US Treasury inflation protected bonds yield. Okay, let's look at this one. This is the consumer inflation expectation compiled by the New York US Federal Reserve. All right, as you all know that US Federal Reserve that are being located across US in the various states. So we have the New York Federal Reserve, I'll put it the way that their research department compile this consumer inflation expectation on a monthly basis. So what I could see over here is that in the previous month, it was 3.2%. And right now, consumer inflation expectation now has started to dip down to 3%. So if you look at this scenario over here, let me open up the trend so that you guys could actually have a look. Right, so this consumer inflation expectation for the year ahead. So think about it as a 12-month moving average consumer inflation expectation survey basis, based on the survey calculated by the Federal Reserve Bank of New York. Okay, you can see on my screen here. So I could see that ever since the month of May, it has been inching downwards from a high of 3.3%. That was the highest so far this year. So this is the second consecutive month of inflation expectation deceleration, which what it means that over here is that consumer is now expecting inflation to actually temper down based on this latest survey 1 month, or pardon me, 1 year ahead, which is definitely good for the stock market. Why? Because the US stock market right now, they are actually thriving on liquidity injection. That means, i.e., if we start to see a higher potential chance of inflationary pressure coming off in US, that means, i.e., there's higher chance for the Fed to kickstart its first interest rate cut, which more or less going to be priced in September, high odds right now. And another one, which is rather high as well, close to, I think, 80% chance based on the CME Fed Watch 2 to have another cut in December FOMC meeting. So market is now looking forward to 2 interest rate cuts by the Fed before 2024 ends. So that actually sums up what we call that a rather continuation of this risk on environment. So this risk on environment has been pretty much prevalent on the US major stock indices. So what I could see over here is that the S&P managed to inch out a slight gain of 0.10%. The Nasdaq was the top performer, up 0.2%, led by NVIDIA. Why? Because if you look at the heat map of the S&P 500 over here, the semiconductor is the one that is outperforming the US S&P 500 yesterday, and given that NVIDIA itself is the top performer, one of the top performer within the semiconductor space, up 1.88%, and NVIDIA is I would say that the top component stocks inside the Nasdaq 100. So that actually explained to us the strong outperformance of the Nasdaq 100 yesterday. And also what we could see over here is that the financials, the cyclicals, and as well as some of the energy stocks going to lag behind. So that actually explained the lackluster performance of the Dow Jones Industrial Average yesterday. So you look at the Dow Jones Industrial Average yesterday, was rather, it hit intraday high, and thereafter it actually plummeted and trade sideways throughout the day. And one of the stellar performer was the Russell 2000. Pardon me, that's up. In fact, it's a top performer. My apologies. So yesterday, second top performer was the Nasdaq, but the top performer was the Russell 2000. That is up 0.59%. Also driven by the fact of this optimism of a low inching down consumer inflation expectation survey data compiled by the New York Federal Reserve, which I shared with you earlier on, and that also increased the chances of lower interest rate going forward, because it increased the chances of the US Federal Reserve interest rate cut cycle to come in the near future as well, rather than next year. All right. Okay, so that explains the outperformance of the Russell 2000, which is pretty much dependent on lower interest rate to actually drive an increase in net profit margin. Why? Because majority of the Russell 2000 component stocks do have weaker balance sheet as compared to the much more higher quality earnings potential of the top 10 or top 20 component stocks within the S&P 500 and the Nasdaq 100. All right, and yesterday what we could see over here is that we do see some form of dollar strength coming back into the market, but the dollar strength still remains on resistance on the various major dollar pair. Later I'll share with you all. Gold went down slightly, but that's been our expectation, and it managed to help right at the key short-term support on the intraday basis we highlighted yesterday. And the West Texas crude oil, which will be turned bearish yesterday on a short term due to the breakdown of the West Texas crude oil minor ascending channel support, and that do have a negative follow through in the US session yesterday as well, which closed lower by the end of the US session for West Texas crude oil. So with that, right now let us take a look at, I want to share with you some very interesting fundamentals and intermarket dynamics from a medium term perspective. So let us start with the US stock market first. All right, so for the US stock market over here, one thing I want to highlight over here is the one of the market breadth metrics that I tend to actually monitor using the number of the percentage of component stock that are above the 50-day and the 200-day moving average of the Nasdaq 100 as well as the S&P 500, because some of we call it, if you look at social media, some of the strategists or some of the traders or analysts, they keep on mentioning that the US stock market is having a bad breath. Yeah, possible. I mean, if you look at one angle, because of only certain component stocks in the US stock market is leading the fort, which is, we all know that is the mega cap technology stocks. All right, but however, certain metrics over here in terms of market breadth is not that bad. Okay, one of them is looking at the percentage of stocks inside the Nasdaq 100 and inside the S&P 500 that is either is above the 50-day and the 20-day moving average. Why I use 20 and 50-day instead of 200? Because this is medium-term trend. If you want, you could look at the 200-day moving average. So that's for the long-term major trend, okay, phases. So let's start with the Nasdaq 100. So the Nasdaq 100 for sure, yes, we know that Nasdaq 100 is being led by the NVIDIA, Microsoft, Facebook, Apple, Amazon, the top five, okay, the top five mega cap stocks. But however, the percentage number of stocks, right, not including this top 5-7 mega cap stock, has also improved throughout the last few weeks or last 2 weeks. So you look at the percentage of Nasdaq 100 stock holding above the 20-day moving average and starts to increase steadily since early June. Now it's at 63% and it's shaping higher low, which is positive. Okay, it's a positive breath. So, and also the percent of Nasdaq 100 stocks above the 50-day moving average has also been improving steadily since the end of early June as well. Right now at 65%. All right, shaping higher low, which is positive breath. Okay, now the key thing is the S&P 500 percent of stocks above the 20-day. Yes, if you look at absolute term, some analysts will say that it's still below 50% because right now it's at 47%. But if you look at on a relative basis, taking into account of as the time progresses since early June, this metric here is going to shape higher low. That means, i.e., the percent of S&P 500 stocks holding above the 20-day continues to improve, getting more day by day. So initially it was at around 24%. Thereafter, somewhere around middle of June, it increased to 33%. Yes, it shoot up towards we got 24th of June at 66%. Thereafter, it came down, but it formed a higher low. This low is higher than this low, and right now, yesterday it tries to tick up again, another higher low. All right, so if you realize that over here is that the path of improvement is generally slowly ticking up for the percent of S&P 500 stocks above the 20-day, now at 47%, which is also positive in terms of market breadth. And now if you look at over here is that the percent of stocks holding above the 50-day moving average for the S&P 500 is not so great as compared to the 20-day one, but it's still hovering at 45%, which is also generally slowly showing signs of improvement since early June over here as it start to shape a series of higher low. All right, and yesterday low is above this low. Okay, so what we could see over here is that this market breadth indicator, which is you seeing on your screen right now using the percentage of component stock within the Nasdaq 100 and the S&P 100, how many of them are how many percent of them are holding above the 20 and their 50-day moving average? All of them are showing signs of improvement, and there is no clear indication of that we are right now seeing an imminent 20% corrective pullback, or even 10% corrective pullback on the S&P and the Nasdaq 100. So the medium term uptrend still remains intact for these two indices. All right, and hopefully the laggard, which is the Dow Jones Industrial Average, will continue to catch up as the bull steepening of the 2-year and the 10-year US Treasury yield continues to play up, which could start to see the value factor coming back into the picture. I will not touch more about that because this potential value outperformance in line with this bull steepening of the 10-year and 2-year Treasury yield, I've covered much ground yesterday already. So for those guys who miss out on this aspect of this yesterday's we call it intermarket dynamics, what I shared, could look back in our OANDA Asia Pacific YouTube video and search for that under the intermarket analysis tab in my yesterday's daily dose. All right, so this is the intermarket dynamics for the US stock market. Now let me talk about the interdynamics for the Japanese yen. All right, so we know that the Japanese yen has been very weak since the start of this year, and even 2 years back. Why? Because the Japanese yen plummeted close to a 38-year low against the dollar. So if you look at the Japanese yen over here in terms of their performance chart, okay, let me share with you this performance chart. Yeah, this is the performance chart. Okay, so this rolling performance chart, I use 1 month. Okay, not too short term, it's medium term. So it's the 1 month rolling performance of a G10 yen crosses. So yen will be the variable currency, and the left side, the base currency, will be your G10 currency, like the Aussie yen, the we call it the Sweden NOK yen, the CAD yen, the sterling yen, the euro yen, and even the dollar yen over here, okay, in black. Okay, so I could see over here in the past 1 month very clearly the yen is weakening. All right, because all these lines are sloping upwards. All right, think of it that more Aussie dollar is actually quoting at a higher rate against the Japanese yen. All right, but what's interesting over here is that since the start of this month over here, let me highlight this in border. Okay, okay, 4th of July. Since the start of this month, what we could see over here is that the G10 yen crosses has starts to show signs of a bit of what you call retracement in their previous strong outperformance against the Japanese yen, especially the Swiss yen that is underperforming right now, followed by SEK yen and dollar yen. The one that is still holding on the fort very clearly is the Aussie yen, because the Australian dollar continues to remain strong, and as well as what we could see over here is that the Australia Central Bank RBA, in terms of their monetary policy, they are still earing to the possibility of one interest rate hike, not cut, hike before 2024 ends. So that actually explain the current bullish dynamic of what you see over here on your screen on the Aussie yen 1 month rolling performance right now. Okay, so now the key question over here is we ask ourselves is that can this particular we call it potential relief rally of the Japanese yen be sustainable? That means, i.e., can all these particular other pair other than Aussie dollar or other than the Aussie yen continues to inch or drift downwards? Okay, so once all these lines drift downwards, it means that the yuan, the Japanese yuan, is actually strengthening. So can this ongoing, I put away that relief rally of the Japanese yen be persistent? So one of the reasons fundamentally it may be supported. Why? Because right now there are more evidence of US leading economic indicator has started to show signs of softness. Example, the ISM services PMI data for June in US went down to below 50 for the first time since about almost a year. So that's actually showing signs of contraction in the US economic growth, given the fact that, do not forget, the services PMI measures the activity in the services sector in the US. And the services sector in the US is very important, very pivotal. Why? Because it contributes to 3/4 of US economic growth. Okay. Secondly, another metrics that which is the Fed is always watching is before this ongoing data dependent Fed is always watching is sluggishness or softness in the US labor market. So on last Friday, we start to see an uptick in the US unemployment rate from 4% in May to 4.1% in June. And also the prior 2 months of non-farm payroll data, the monthly added figure for the month of May and April has been revised downwards. So this clearly tells us that the US labor market has also shown signs of softness. So given these two key economic leading indicator in the US is showing signs of a downward drift, that could actually give this data dependent Fed more support to ignite a interest rate cut rather than an interest rate hike before 2024 ends, and potentially there could be a high chance of 2 interest rate cut by the Fed. And given the fact that with that taking shape, BOJ, Bank of Japan, will be much more comfortable to kickstart their normalization policy, looking out for another, we call it a token hike in July or September this year. Then with this particular dynamics that's playing out, what we could see over here is that the yield spread between the US Treasury yield and the Japanese JGB yield has starts to narrow down, as evidence from this spread over here. Let me share it with you all. Okay. Oops, sorry. Let me reduce this. Let me reduce this. Let me reduce this. Okay, so this blue line here is the spread between the 10-year US Treasury yield over the 10-year JGB yield. So think of it as 10-year US Treasury yield minus 10-year JGB yield. So you could look over here is that currently is slowing down from a high that was seen in late April this year at around 3.8%. Right now it has drifted downwards to 3.2%, and this is the lowest level since early February this year. All right, and it's looking to break below this support. Okay, so once it break below this support area here, potentially it could plummet close to a level that was seen in April 2023. That's about 2.9%. So what it means that this downward drift or the yield premium shrinkage of the 10-year Treasury yield minus the 10-year JGB yield indicate to us that the positive carry is getting lesser if any traders were to long dollar yen. All right, so with the positive carry getting lesser, it will actually reduce the attractiveness to be using yen as a funded currency. All right, so what do you mean by using yen as a funded currency? That means you short yen against other major pair like the dollar or even Kiwi or even the Aussie. But if you use it against the dollar over here, potentially the carry will get lesser because of this potential higher chances of a more dovish Fed going forward. Very similar, what we could see over here is that the 2-year US Treasury yield minus the 2-year JGB yield as well is also doing this downward drift from a high that was seen in late April at 4.77%, now inching downwards to 4.27%, and also looking to test this February low, and which is also the support area as well at around 4.14%. A breakdown below this level also potentially revisit last year April's low at 3.8% or 3.7% thereabout. Okay, so also indicating to us that the lower term yield, the 2-year, also showing signs of a yield premium shrinkage from the US Treasury over the JGB. Okay, so it's also indicating to us that the positive carry is getting lesser if you were to take into a perspective of comparing US related assets against Japanese assets. All right, so net overall, this particular chart that I'm trying to share with you is it's actually giving us more evidence that potentially the ongoing relief rebound that was seen in the Japanese yen on late last Friday could actually persist for a while, at least from a short-term perspective. All right, the longer term major trend of the dollar of the yen, persistent weakness hasn't been reversed yet. If you look at from a technical analysis perspective chart by looking at the monthly chart or on the weekly chart itself. Okay, so with that actually sum up today's intermarket dynamics on the share with you all. So right now, let us now jump straight into the short-term intraday technical outlook. All right, starting from the dollar major pair first. Okay, so before we go there, let me expand my screen so that you guys could see much clearer on the key levels that I would be highlighting to you shortly. Okay, so let us start with the euro dollar. All right, so for the euro dollar, what we could see over here is that it continues to trade within this medium term ascending channel at the upper limit of the medium term ascending channel that I drew. Okay, not pardon me, the upper limit of a short-term ascending channel or minor ascending channel that I drew from the low of 26th of June. So what we could see over here is that I also continued to yesterday it managed to revisit last Friday's swing high area before trading sideways. Okay, so right now nothing of a major in terms of technical configuration, there is no clear signs of a toppish configuration in the short term, as price action continue to hold above the 20-day moving average, the 50-day moving average as well. Okay, and what we could see over here is that I'll be still using a slightly adjusted upwards 1.079 short-term pivotal support level. Okay, to maintain my short-term intraday bullish bias on the euro dollar. First resistance zone to look out for in the near term will be at 1.0850, 1.0860, which is so confluencing with the top of this ascending channel. And graphically, is also this congestion area here, 5th of June, and as well as the minor swing high of 12th of June. And if you do the Fibo extension taken from the start of this ongoing minor uptrend in the euro dollar, project it up, push it down to the low, minor low of 2nd of July, it confluenced with the 1.236 and the 1.382. All right, above 1.0860 exposes the next near-term resistance zone of 1.09/1.0925, which is this minor swing high of 6th of June and 4th of June this year. Only an hourly close below 1.079 will invalidate today's intraday bullish bias on the euro dollar to see it shaping a much more deeper corrective minor pullback to test the next near-term support area at 1.0770, which is the former minor swing high of 1st of July, and as well as the lower limit of this minor ascending channel level. Only a breakdown below 1.0770 will see a much more extension of this deeper corrective pullback to retest the 20-day moving average. That's also acting as a support at 1.0750. Okay, that's for the euro dollar. Sterling dollar over here. So for the sterling dollar, yesterday it actually shaped a higher high that broke above last Friday high. All right, so it's actually outperformed the euro dollar. So no changes managed to actually hit a higher high. We will actually tighten the key short-term pivotal support level to last Friday minor swing low, and also as well as the pullback line of this former symmetrical triangle range configuration. Upper limit now turns to the pullback support, coming to act as a support level at 1.2760. So using a tightened key short-term pivotal support for today, 1.2760, to maintain this ongoing bullish short-term intraday bullish bias on the sterling dollar. Next resistance in near term to watch out for will be at 1.2860, which is the minor swing high of 12th of June. Thereafter, a breakout above it sees the next medium-term resistance zone to come in at 1.2930, 1.2940. Only hourly close below 1.2760 invalidate today's intraday bullish bias to see the sterling dollar or the cable to extend a deeper corrective pullback to expose the next near-term supports levels at 1.2730, followed by 1.27 figure level, which correspond to the 20-day moving average that's acting as a support level as well. Right, now moving on will be the dollar major against the Asia Pacific currency. Okay, so starting with the Aussie dollar first. All right, so the Aussie dollar over here managed to inch lower during the US session yesterday, and today it traded lower, but still holding above our first support that we highlighted yesterday at 67.20. So what's this 67.20 is in fact last Friday minor swing low, and the price action on the Australia dollar, the Aussie dollar, has going to shape a bullish reversal candlestick over here, bullish hammer, okay, with a positive follow through. And also the RSI also now attempting to shape a bounce up as well. All right, so net overall, what we could see over here is that the short-term bullish dynamic seems to be still intact on the Aussie dollar. I don't want to tighten the key short-term pivotal support to be at 67.20, so I'll still use 67 figure level. Also correspond to the pullback line, distorted gray line of that former medium-term symmetrical triangle range resistance now turns into a pullback support that confluence with the former minor swing high of 4th of June and 13th of June. So as long as the 67 figure short-term pivotal support holds, we will still maintain that short-term intraday bullish bias on the Aussie dollar. Next near-term resistance to watch will be at 67.80. Break above this level exposes 67.825, 68.40 next. All right, so what's this level? 1.618 Fibo extension from the low of this 7th of June, and graphically it's this congestion area over here from 29th of December last year. Okay, now in terms of the next support to watch out for, if 67 figure level is being taken up on the downside, then we have an hourly close below it. This is where the Aussie dollar could shape a much more deeper corrective minor pullback to retest the next near-term support at 66.70, which is also confluence with the rising 20-day moving average. Below it sees the minor swing low of 2nd of July, which is at 66.40. That also confluencing with the rising 50-day moving average as well. That is coming to as a similar support level at 66.40. Okay, so that's sum up for the Aussie dollar short-term intraday technical outlook. Moving on, next will be the Japanese yen, the dollar yen. Okay, so the dollar yen continued to inch downward yesterday. So still recall yesterday we highlight 61.40 as my key short-term pivotal resistance. So we are saying that there could be a bounce. Yes, the bounce take shape, being surpassed yesterday at 61.40. So this was being meteorized during the start of the US session. Then thereafter, it hit our first support at 60.30 before shaping this ongoing minor bounce over here. So all in all, what we could see over here is that potentially it really starts to complete the first 5-wave down corrective move of a potential A or a 1, we call it. So this is 1, 2, 3, 4, 5. So if you do the typical 5th wave, we call it Fibo extension level, okay, 0.764. All right, so potentially right now is actually retracing a ABC of this 5-wave down of 61 after yesterday's 5th wave target has been made on the downside. So if you do a Fibo retracement after a 5-wave down, typically we are looking at 50% and a 61.8% level as an inflection level before another potential down move take shape. All right, so what we could see over here is at 61.30, okay, which is very close to yesterday's uh, resistance as well at 61.40 level. Okay, then what we have over here is that no change, so I will still maintain that 61.40 as my key short-term pivotal resistance level to maintain this intraday bearish bias on the dollar yen. First support 160.30 for sure, because that was tested yesterday. A breakdown below it exposes the next near-term support at 159.90, which potentially also confluencing very closely with this rising 20-day moving average. All right, only an hourly close above 161.40 will invalidate this intraday bearish bias on the dollar yen to see it squeezing up to retest 161.95 and even 162.40 next. Okay, on the dollar yen. Now that sums up the short-term intraday technical outlook on the dollar major pair. Let us now shift our focus to the major stock indices, starting with the Asia Pacific stock indices first. All right, so what we have over here is the Hang Seng Index, or the Hong Kong 33. So Hong Kong 33 yesterday we do flip to a bearish bias. Why? Because of the breakdown of the key short-term support level. So the first support level has been made at 17,460. All right, already been hit. All right, so this level has been really been met. So what we are now focusing on will be, oops. Okay, let me remove this again. Okay, good. Okay, so with the price action right now that is coming very close to the 17,170 support area, this area here over here, and this area is why it's important, because it's the lower limit of this minor descending channel that I drew. So this could be a terminal or inflection level, and as well as the 200-day moving average. This is a key long-term moving average, and the former minor swing high of 13th of March and 11th of April. After the breakout, this level managed to see the steep rally that took shape from late April all the way up to mid-May, okay, before this decline take shape. Okay, so this seems to be a key inflection level. If the bulls got to come back, this level here got to shape that bullish reversal, okay, in terms of the psychological impact that it has previously. Okay, so what's interesting over here is that yes, price going to inch downwards, lower low, and what we could see now is that the hourly RSI has starts to shape a higher low. All right, so using that, I'll be using this level here as my short-term pivotal support instead, because since it's now coming very close to this key inflection level. Okay, so it's like a make or break level for a potential at least a minor recovery given its previous key psychological impact. So as long as this level holds, okay, so let me change this to a normal resistance level. Okay, so as long as this 17,170 short-term pivotal support level that I highlighted for today, to flip to a potential short-term intraday bullish bias for a recovery, minor recovery, I would say. Next near-term resistance to watch, 17,585. A breakout above it exposes 17,790, maximum 17,970, which correspond to this still declining 20-day moving average. All right, only an hourly close below 17,170 will invalidate today's intraday bullish bias to see the extension of this corrective decline to expose the next support area at 16,910 level, which is this area here. Right, and also the 76.4 Fibo retracement of that previous steep rally from 19th of April all the way up to 17th of May. Okay, that's for the Hong Kong 33 or the Hang Seng Index. Now will be the Japan 225 or the Nikkei 225. So the Nikkei 225 yesterday it consolidated but didn't shape that desired pullback to 40,506 and instead shape a bullish breakout. So we got to respect this ongoing bullish impulsive wave sequence that is still unfolding in the Nikkei 225 over here. So with that break of that 41,170 level, so that was this dotted green line here, was the yesterday's short-term pivotal resistance in order for it to be kept. Once it's breakout over here, that the odds of shaping that much more deeper corrective pullback towards 40,406 has been greatly reduced. So right now we could see is another round of impulsive up move. So first support level to watch out for will be at the 41,160 level, using yesterday's intraday minor low or the range congestion area, the minor range congestion area, as my short-term pivotal support level. So as long as this level didn't surpass to the downside, 40,800, will flip to a short-term intraday bullish bias on the Japan 225 or the Nikkei 225. Next resistance to watch will be at 41,770, followed by the upper limit of this minor steep ascending channel that I drew from 2nd of July, coming to act as the next resistance at the psychological level of 42,000. Next, and above it sees 42,200, 42,280, which is confluencing with a bunch of Fibo congestion area. Over here, if I do from a nested Fibo extension taken from the minor low of 27th of June, project it to 28th of June, push it down to the low of 2nd of July. Okay, this gives rise to this level here, 3.618. All right, only hourly close below 40,800 will invalidate this short-term bullish bias on the Japan 25 to see a deeper corrective minor pullback to revisit 40,506 and even 40,230 next. All right, so that's for the Nikkei 225. Moving on will be the German 30 or the German DAX, which continues to trade in a rather undecisive faction. Yesterday, we highlighted 80,640 short-term pivotal resistance. Yes, retested, come break above it. Prices going to inch downwards. Now back into the former descending trendline resistance that I drew from the high of 16th of May. So clearly indicating that there is still no clear sign of a bullish bias that able to break above 18,640. So still using 18,640 as my short-term pivotal resistance, which is very clearly being tested yesterday, and then thereafter it float back down. But in order for the bears to actually gain more traction, it got to break below our first support level that we highlighted yesterday, 18,430, that managed to help as well. So a breakdown below, only a breakdown below 18,430 potentially could see a much more deeper, we call it reintegration back to retest the 20-day moving average, now acting as a support at 18,300. Only an hourly close above 18,640, that means a breakout of your hourly close above 18,640 will invalidate today's intraday bearish bias to kickstart another round of, a round of bullish impulsive up move in first step to expose the next near-term resistance at 18,750, followed by 18,450, no, 18,845, 18,900 next. Okay, that's for the German 30. US Wall Street 30, the Dow Jones Industrial Average, no change, still the same. Yesterday hit the first resistance level before selling off, then it tries to recover again. So net overall, we still maintain that short-term pivotal support level at 39,090, 39,030, because that also confirms with the lower limit of this ongoing range configuration, a kind of a sideways rectangle range that is in place since the high of 24th of June. Again, the lower limit is at this 39,090, 39,030, which also correspond to the rising 20-day and the 50-day moving average. So net overall, the next resistance to watch out for, first one will be at 39,600. A breakout above it re-exposes 39,790. That was almost hit yesterday as well before coming back down. However, only hourly close below 39,030 will invalidate today's intraday bullish bias to kickstart a deeper corrective pullback to see a retest at 38,730, which correspond to this rising minor trend line support level that is in place since 30th of May. A breakdown below it exposes the next near-term support zone of 38,560 / 38,420 next. Nasdaq 100 over here continue to inch higher high, higher low, and hit the first resistance that we highlighted, 20,490, pardon me. So with that, there is also still no clear signs of a bullish exhaustion. The hourly RSI continues to shape a higher high over here. Okay, no clear signs of a bearish divergence. Okay, so net overall, we'll still maintain this ongoing bullish short-term intraday bullish bias on the Nasdaq 100. So what we'll see over here is that the first support level to watch for any signs of a minor pullback could potentially be this area here. Okay, at 20,400. Okay, 20,400 level, but I don't put it so tight. I'll be using 20,210 level as my short-term pivotal support for today. Taking the fact that if I do the entire Fibo retracement, that correspond to 38%. Okay, just in case the pullback starts to shape a deeper corrective wave, minor wave fall. All right. So using 20,210 as my short-term pivotal support, as long as any minor pullback managed to hold at this level, we will still maintain that short-term intraday bullish bias on the Nasdaq 100. The next resistance to watch out for, 20,620 / 20,710, followed by 20,900, which is close to the upper limit of this minor ascending channel that I drew from the low of 31st of May. Only hourly close or a breakdown below 20,210 will invalidate today's intraday bullish bias to kickstart a much more deeper corrective decline to test the next support at 20,000, followed by 19,850, which also correspond to the rising 20-day moving average, and as well as the lower boundary of this minor ascending channel that I drew from the low of 31st of May. Okay, so that sum up the short-term intraday technical outlook on the major stock indices. Let us now focus on the commodities market, starting with gold XAU / USD. Okay, so for gold XAU / USD, the price action actually pulled back as expected. Over here, hit the lower limit of the short-term pivotal support zone that we highlighted yesterday, 2,362 / 2,350. So for sure, this level is indeed important. If not, why the price bounce from here? We got to question that. All right, so no change, 2,362 / 2,350 short-term pivotal support to maintain that intraday bullish bias on XAU / USD. First resistance to watch out for will be the minor swing high of last Friday. Okay, let me tidy it up slightly. Okay, at 2,391. Okay, 2,391. Okay, above 2,391 sees the next near-term resistance to come in at 2,410, which correspond to the two-time Fibo extension from the low of 26th of June. Taking into account of this is the start of the newly impulsive up move, and corresponding to the minor congestion area of 21st of May and 22nd of May over here. Only hourly close below 2,350 will invalidate today's intraday bullish bias to see the continuation of this minor corrective decline to retest the 50-day and the 20-day moving average that is also confluencing with the next near-term support level at 2,335. Below 2,335, then we will question last week bullish breakout scenario. Why? Because this 2,035 also confluence with the pullback of this former minor ascending descending channel resistance now turns into a pullback support, the dotted gray line here. Okay, so if we reintegrate below the 2035, then last Friday bullish breakout will be very questionable. That means that could be a failure bullish breakout where price action could shape a deeper drop to retest the start of this month minor swing low at 2318 in the first step. Okay, so now that's for gold. Let us move on to West Texas oil. So West Texas oil yesterday continues to drop further as expected, hit the first support level at 81.90. So given the fact that the RSI has just started to exit from the overbought level, potentially there could be signs of a minor bounce taking shape. So as long as this bounce didn't surpass a tightened key short-term pivotal resistance that we highlight for today, 83.55 level. So this 83.55, if you were to expand it, it also correspond in terms of the Fibo retracement of this ongoing decline, the 50%, all right, the 50% Fibo retracement and the graphical area over here. So as long as 83.55 short-term pivotal resistance is not surpassed to the upside, we will still maintain that short-term intraday bearish bias on the West Texas oil. A breakdown below 81.90 exposes the next near-term support at 81.30, which also confluencing with the rising 20-day moving average as well. However, an hourly close above 83.55, then this ongoing minor corrective decline may have ended, where we may start to see the continuation of the ongoing impulsive up move for West Texas oil, retesting the last Friday minor swing high area at 84.40/85.05 level. Above it sees the next resistance coming in at 86.20, which is the minor swing high area of 19th of April and 16th of April. Okay, so that sum up the short-term intraday outlook on the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So for today, during the European session, we do have one Bank of England official speaking, a Bank of England official, Cleveland, speaking at 4:05 p.m. Singapore time. And over here, we do have another ECB officials, Kipolon's speech as well at 5 p.m. Singapore time. And the all important will be this Fed Chair Powell testimony to Congress at 10 p.m. Okay, then after that we have 9:15 p.m. His colleague will be speaking. That's a normal public speech, but this Fed Chair Powell testimony is important. Why? Because that's considered as a semi-annual testimony to Congress. So he will address two houses of finance over here. One will be in the Senate, one will be the Republic, the House of the Republic. So at the 10 p. So this 10 p.m. one, market participant will be having a close ear on Powell's speeches, especially do he address the ongoing softness that was seen in the recent key economic data, especially the ISM services PMI and the non-farm payroll data that was released on last Friday. So any mention of such softness of this key economic data could portray an indirect stance by the Fed Chair Powell to kickstart the first interest rate cut in US pretty soon. Okay, this is something to watch out for. Then thereafter, we do have a rather quiet US session, and we do have a US Treasury Secretary testimony as well, but there's no time given. All right, so something to take note of. And during the Asia early Wednesday morning at 1:30 a.m. Singapore time, we have another Federal Reserve official speaking, Fed Bowman speech. And before the start of our daily dose, we have two economic data, inflation one, Japan, which is the Japanese PPI data, something to look out for. Any signs of a further uptick in the Japanese PPI data, where markets expecting a further uptick to 2.9% from 2.4% in the previous month of May, could see a further upside, we call it inflationary improvement in Japan. So that could also support the potential yen relief rebound, the Japanese yen relief rebound that we're seeing right now. And more important, closer to our shore will be the China inflation data and the China PPI data that's out later at 9:30 a.m. Singapore time tomorrow. All right, and we've also, for those guys who are looking at the Kiwi dollar, we do have the RBNZ interest rate decision out at 10 a.m. Singapore time tomorrow. Market is expecting no change at 5.5%. Okay, so with that, that sum up today's daily dose of market insights. I wish you all a great day ahead. This is Kelvin here signing off, and we shall speak again tomorrow. Thank you.